Good morning, everybody. My name is Tyson Moore. I'm a supervisor in the not-for-profit division here at DWD. I want to take this time to thank everyone for joining today's webinar. We're going to cover internal controls today. With us is Susan Berghoff, along with our presenter, Carrie Minnick. Before we get started, I want to touch on a couple of housekeeping items. For those of you who are going to ask questions today, please use the question and answer feature. You can find that option in the toolbar at the bottom of your screen. Both Susan Berghoff and myself will be answering questions periodically throughout the presentation. Also, Carrie's slides will be emailed to everyone attending today's webinar, along with being posted to our website. Without further ado, I'll turn the floor over to our Director of Not-for-Profit Services, Carrie Minnick.
Thank you, Tyson. Again, thank you all for attending today. And today we're going to talk about the exciting topic of financial controls. So the Association of Certified Fraud Examiners does an annual study, and their 2020 report, which is the latest report that's available, stated that nonprofit organizations have fewer anti-fraud controls in practice, leaving them more vulnerable to fraud. So why is that? Usually these are common vulnerabilities that nonprofits have. Not all nonprofits have these, but sometimes there's limited personnel, limited resources. Sometimes the executive leadership is stretched too thin. As far as the board, there could be a lack of financial expertise or maybe a disengaged board. There's also a culture surrounding charitable purpose that, this is an organization. Everyone here wants to be here for the charitable purpose. Nobody would do anything wrong. No one would commit any kind of fraud against the organization. And then also small organizations don't need to have internal controls or can't afford them. And that's just simply not true. For small organizations, it is possible to tailor controls to address control risks within the organization in a cost-effective manner. And we're going to go over some of those today in this webinar. So again, back to the Association of Certified Fraud Examiners report, they found that the top 3 control weaknesses in nonprofits are a lack of internal controls, lack of management review, and the overriding of existing internal controls. Some of the fraud schemes that were discovered in their report, the biggest one being corruption, then also billing, expense reimbursements, cash on hand, non-cash fraud items, skimming. And you can go on the slide here, you can see the list of different schemes that are prevalent in nonprofit organizations. So how are these schemes detected? So they found that the highest rate was by a tip or complaint at 40%. And then second was internal audit, management review, or just by accident was 7%, and then also examination of documents. So you'll see on this screen that nowhere on here does it say an independent audit. So if your organization has an audit done, that is not going to necessarily discover any fraud within your organization. That is not the point of having an audit done. Obviously, if we find something, we will definitely, address that. But having an audit done does not automatically save you from having fraud or find fraud within your organization. So who is responsible for making sure that controls are in place? Obviously, the board of directors. Those charged with governance should assume the overall responsibility for the organization's internal control strategy. Just like anything else, they're ultimately responsible. This also includes policies and systems, and they need to really act accordingly. Management is the one then that should design, implement, monitor, evaluate, and report on the organization's internal control system in accordance with policies and procedures approved by the board. And then we have the employees who they need to be aware of these policies and also need to be held accountable for proper understanding and execution of internal controls within their specific job responsibility. And then obviously volunteers of your organization also need to be aware of the policies and procedures in place. You really need to get a good buy-in from everyone within the organization in order for the controls to work effectively and how they should. So obviously controls are important to have, but let's think about really why. Why are we really focusing on controls? They're going to safeguard the assets and resources, so preventing theft of the organization, detect or deter fraud within the organization, also improving reliability of financial reporting, making sure that those numbers and amounts, transactions that you're reporting are properly stating the organization's activities. Controls also reduce the risk of errors or misstatements in financial reporting. Also, you want to make sure your organization is complying with rules and regulations. The existence of controls also demonstrates accountability as stewards of the organization's resources. Because remember, an organization, a nonprofit, is not owned by anyone, unlike a for-profit that usually has owners that are benefiting from the organization's revenue. A nonprofit exists for the benefit of the community, and so we are entrusted with those assets. So we want to make sure that we're using those assets as we should. And then also to support the organization in achieving its mission. So before we get into what kind of internal control should be in place, let's just go over a basic definition of what is internal control. So internal control is a process affected by an entity's board of directors, management, and other personnel. So again, those individuals that are responsible, designed to provide reasonable assurance regarding the achievement of objectives relating to operations, reporting, and compliance. So we need to remember that controls are a process. People affect processes. So you bring different people into the process, the process is probably going to change a little bit. Also, internal controls provide reasonable assurance, not absolute assurance against fraud occurring. Some of you might be familiar with COSO. This is the Committee of Sponsoring Organizations of the Treadway Commission. So what this is a joint initiative of 5 organizations got together and developed a framework and guidance to help organizations design and implement internal controls. So this is a means to apply internal controls to any type of entity. So whatever the mission, whatever the size, this will help all nonprofits establish policies and procedures to assure that the assets are managed properly and that the boards understand their fiduciary responsibilities and that the charitable purposes are carried out. For those organizations that are audited by DWD, you may recognize COSO from the COSO questionnaire that we ask you to complete in preparation for the audit. So that kind of is a questionnaire that we give to our audit clients to help us understand what controls they have in place. And this is the basis for that questionnaire. So if we actually look at the COSO framework, it can be kind of overwhelming. It is divided into 5 different categories: the control environment, risk assessment, control activities, information and communication, and monitoring activities. So there's 5 components of internal control. And then within those 5 components of internal control, there are 17 principles underneath of those 5 that are really fundamental concepts that align with each component. Then within those 17 principles, there's an additional 81 points of focus or characteristics of principles. So for example, if we just take the first component of internal control environment. So the first principle is demonstrates a commitment to integrity and ethical values. So does your organization demonstrate a commitment to integrity and ethics? And how do you do that? So that's somewhere to start with that. So again, if you actually look at the whole entire framework and the document that is available with all of these points of interest and principles of internal control and components, it can be kind of overwhelming. So let's break this down. What does this actually mean? So in the simplest terms, the 5 components of internal control, the very first one, control environment. So what is the tone at the top? Does management take control seriously? Does the board care about if there are controls in place, that people are following them? Is there some kind of repercussion if controls are not put into place or not followed? The second one is risk assessment. Has management identified risky areas and implemented controls in those areas? The third is control activities. Are there policies and procedures in place? Do you have written policies on how to process accounting procedures, on how to process payroll, on how to receive donations, that type of thing? Under information and communication, are the technology, accounting, and communication systems and processes understood? Are they communicated to employees, to board, to the volunteers, and do they understand them? And finally, under monitoring, are the policies and procedures working? So again, the previous slide talks about the whole COSO framework, very detailed, lots of different points under each of them. This slide just kind of summarizes in a very basic wording what each of these 5 components of internal control are. So when you're looking at those and starting to implement controls or reevaluating the current controls that you have within your organization, here's a place to start. 5 questions for the 5 different areas. So as we get into these different areas, the first at the tone of the top. So this is probably the easiest thing that you can do is start with your organization's culture. So for example, if employees are expected to submit receipts for reimbursements, your leadership has to do the same thing. So setting an example, what does the tone at the top do? And whatever they are doing, other people within the organization are seeing that, your employees, your volunteers. So they need to set an example. You really should have an organization of transparency, accountability. Again, the leaders, the ED, the CEO, they really should model the behavior that they expect to get from others within the organization. One way to do this is to implement a code of conduct. A lot of organizations will include a code of conduct or a code of ethics, some type of similar code within their employee handbook, which is perfectly fine. And then also reinforcing that with a whistleblower policy and a conflict of interest policy. And these are 2 policies that the IRS does ask on the Form 990 as to whether your organization has these in place, the whistleblower policy and the conflict of interest policy. So if you do not have these in place, recommendation to put those in place. If you do not have them and would like a template for these policies, whistleblower policy, conflict of interest, please let us know and we would be happy to provide that to you. So easiest way to start with your controls is looking at the tone at the top. Next, we talk about a risk assessment. So really all we're doing is looking to see what risks are there in achieving your mission. And a risk is any adverse event that could prevent you from achieving your mission. So you're probably already doing this within your organization. It's just probably more on a siloed approach. Because more than likely, you're probably looking at your IT and technology, you're looking at your finance, maybe for special accreditations, you're looking at different risks. But if you are doing these, sometimes they're kind of each done on their own. And by doing a more siloed approach like that, you're really missing out on the organizational wide assessment. So bringing all of those people together, having the right people at the table from each of those different areas will allow you to get a better picture of what is going on within the organization, where the risks are. And you might actually find areas of duplication or where the organization could be more efficient if you're bringing all of these people together. It's also a good opportunity to better learn what others are doing within the organization in those different areas. So in order to address risks, you really have to know what they are at first. All entities are faced with risks. You're not going to be able to address every single risk, but you also can't ignore them. So you have to prioritize which risks are highest for your organization and then realign resources to those highest risks. And I have listed here some possible risks that are common with nonprofit organizations. These are not necessarily applicable to every organization, but some revenue concentration. So if your organization relies significantly on receiving revenue from a specific funder or if it's a specific source, what happens when that source goes away? Will you be able to continue to provide your programming? Will your organization be able to survive? Compliance, if you get government money or grants that require you to do specific programming or spend your money on specific expenses, are you following that? There's a risk that maybe those funds aren't being used for what they're supposed to be doing. Segregation of duties is always a big one, especially in smaller organizations. Staffing, volunteers, just general security. And then a big one with nonprofits is restricted funds, making sure that donations that are received from funders for a specific purpose that have been restricted for those by those donors are being spent for those items. We really want to make sure that if a donor gives us money for a specific purpose, that it is spent according to the donor's intent. And then the last one is the reputation, your organization's reputation. That's one of your greatest assets. So if for some reason something happens to your reputation, that could really hit your organization hard. And it is very difficult to recover from that. So as you're starting this process, there really isn't one right way to do risk management, but you have to start somewhere. And that somewhere is usually just with the conversation, getting the leaders together within your organization, maybe your heads from your different departments, and start talking about brainstorming about the different risks within your organization. As part of the risk assessment process, we also talk about the fraud triangle. And so when these three areas are prominent, then there's more likely risk for fraud. So opportunity, if someone has the opportunity to commit fraud, for example, if there's no oversight as to what they're doing, there's an opportunity there that they could get away with something. Rationalization, if they are rationalizing, hey, I should do this because I'm not getting paid as much as somebody working in a for-profit, or I'm going to take this money because our organization got a really large grant. So I know that our organization has a lot of money or a very large endowment, so they're not going to miss this. And then the third one is pressure. So if there's pressure either from the higher up, the board, maybe an outside funder, some kind of pressure that's being put on an individual, that can also create an opportunity or an option for fraud. So when you're looking at those different risks, it's important to look at the opportunity, rationalization, and pressure items where fraud could possibly exist. So that's kind of a little background first, just on controls, the COSO, why controls are important, that type of thing. So now we're going to give you some specific controls that you can put into place into different areas within your organization. And these controls are applicable for any size organization. It doesn't have to be just the large ones. It can be small organizations as well. So the first one we're going to talk about is bank accounts. So some things that you can do related to your bank accounts. Limit the number of bank accounts that you have. The more bank accounts you have, the more opportunity for funds to go missing, because we have more accounts, we have probably more people touching it. So just limit the number of accounts that you do have. Obviously, you're probably going to have more than one. That's fine, but just don't have an excessive number of accounts. Along with that, limit the number of check signers. Not everybody needs to be able to sign a check or have online access. So think about who needs to sign checks, who needs to have online access, and limit that to the correct individuals. Also, you want to make sure that when your board treasurer, for example, or your board chair who are check signers, when that person turns over, you need to make sure that you change that with the bank. Let the bank know and change that check signer as well. When you're opening up a bank account, make sure that it is the bank account is in the name of the organization, and that it is going to the organization's address, that the bank account is not in an individual's name and is not going to an individual's private address. If you are an organization that does not have a physical office location, you can easily open up a PO box and have your statements mailed there. Monthly reconciliations. I cannot stress this one enough. Please, please make sure that you are reconciling all of your bank accounts monthly. Pretty much all of your organization's activity is going to go through your bank account. And so if you are not reconciling that, that is a big deal. You want to make sure that you're reconciling it timely, and then also make sure that it is reviewed by somebody else. When someone reviews your reconciliation, make sure that they are reviewing not only the bank reconciliation, but they're also looking at the bank statement. And if you get cleared checks back from the bank, I know a lot of people don't get those anymore, but sometimes you can still get the little scanned images on the bank statements. Make sure that they're looking at those for reasonableness as to, who's signing those checks. And also when they're reviewing the bank reconciliation, make sure that the person is looking at the reconciling items, those items that have not cleared yet. Are they old? Are they reasonable? Are they legitimate outstanding items? Or maybe they need to be adjusted. And then with anything, when that review is being done, make sure that they sign off, like physically, initial and date the bank reconciliation. Now you can do this electronically too, but just make sure that you have that review noted on the bank reconciliation. One bank account equals one GL account. We don't want to be having two bank accounts going to one GL account, or two GL accounts split between one bank account. It makes your reconciliation much more difficult, much more time consuming each month. It's also a lot more opportunity for things to get recorded incorrectly, duplicates not being recorded right, transfers, that type of thing. So just keep it easy. One bank account equals one GL account. Limit access to blank checks. Obviously, I think that's a pretty self-explanatory one there. Consider bonding employees who handle cash and checks. And then finally, do not use debit cards. Debit cards are essentially the same as cash. If somebody has a debit card, they have complete access to your organization's bank account. We do not encourage people to use debit cards. Please, if you want to use a card, use a credit card. There's a lot more control over a credit card versus a debit card. So we really encourage you not to use debit cards. In that same manner, please do not use debit cards to withdraw cash from the ATM. There are times when you might need cash, but then that's when you have a petty cash fund. We don't want to have money being taken out of the bank, of an organization's bank account through an ATM withdrawal, because there's no documentation as to what that cash was being used for. So again, those are just some suggested controls that you could consider putting in place if you don't already have in place related to your bank accounts. Next, let's talk about receipts. So this is money coming into the organization. So making sure that the handling of the receipts is independent from the accounting. And again, we totally understand that small organizations may not have the ability to segregate all duties. And we're going to talk about that in a little bit, how to do that with the staffing that you do have. But as far as you can, separating the handling of receipts from the accounting. And this includes the opening of mail, taking deposits to the bank account. When you do get your daily receipts, your checks in the mail, make a list of those receipts. Have whoever is opening the mail make a list of the checks that have been received. And again, that should be someone outside of the accounting department. And then that list of receipts can be compared to what went through the bank statement by the reviewer of the monthly bank reconciliation. So that way we can make sure that what came in the door was actually ultimately ended up within the organization's bank account each month. The immediate endorsement of all receipts. So making sure that all checks that you receive are stamped for deposit only on the back. Making timely deposits. We don't want to have a large amount of checks sitting around the organization's office. So when you do get that money in, make sure that you're taking it to the bank timely. Sending thank you letters to donors. So this will help with making sure that money that was sent to the organization is ultimately received by the organization. So if a donor gives money to the organization and they don't receive a thank you letter, they may question that and contact the organization and say, hey, did you get my contribution? I usually get a thank you letter from you, but this time I didn't get one. So that may trigger an instance where maybe that check didn't end up where it was supposed to end up. And then finally, reconciling the donor database with contribution revenue. So the development department or your fundraising department doesn't always have the same information as the accounting department. So we want to make sure that we reconcile that on a regular basis. So, and they're not going to. The development department is tracking gifts made. Sometimes they're promises and they haven't been received yet, where the accounting department is may have a different number or different total for the contributions that came in during the year, because it could be on the accrual basis, just the way that they are reported. So there probably will be a difference between what your development department is recording as receipts and what your accounting department is, and that's fine. But they need to talk together, talk to each other to make sure what is being reported can be reconciled. Also, again, back to the donor restricted gifts, it is very important to make sure that you're tracking those. Because again, when we receive money from donors for a specific purpose, we really need to have a control in place to make sure that that money is spent for that specific purpose, so we can honor our donors' intent. So on the other side, disbursements, use pre-numbered checks. Obviously, use them in order. It's always good to use them in the proper order, so that way you can obviously see which checks are missing and which ones have not been cleared. If you have 2 different bank accounts, 2 different banks, make sure that your check numbers are not the same sequence. It's much easier if you use a different sequence for each bank. It just makes it much easier. Use checks for major payments versus cash. You could also do automatic payments, but we're trying to get away from cash being paid for major payments. Don't pre-sign checks. We want to make sure that the signatures on checks are being done after the check has been completely prepared, who it's going to, the dollar amount, the purpose. So making sure that checks are signed afterwards. Do not write checks payable to cash. Again, that opens it up for anyone to have access to that check and can take that to the bank and cash it and get money for anything. So make it out to an individual if you need to get cash for the organization, like to refund the petty cash fund. If you do need to void a check, make sure you maintain those, keep a copy of, or keep the actual check that's been voided, but just make sure that you properly void it. So, tear off the signature corner, or, put a big black X across it, something to clearly make sure that, yes, this check has been voided, but it's also important to make sure that you keep those voided checks in your documentation, so that way we can account for all checks. Review the supporting documentation for approval of payment before the payment is made. So again, before the check is signed, make sure that somebody is reviewing all payments going out, because we want to make sure that before it is actually paid, that this expense is for a legitimate business purpose. This will not only help protect the organization, but also the individual in that position that's creating the check. Making sure that someone else is reviewing it. And again, when they review it, make sure they initial and date the face of the invoice. So that way we can see that, yes, this invoice was reviewed by so-and-so on this date, and it is for a legitimate business purpose. So therefore we can now make that payment. And then also when the check is given to the check signer to sign, make sure that they're not only looking at the check, obviously, but the supporting documentation that goes behind it. Your check signers probably are not familiar with every single expense that you have within the organization. So providing that supporting documentation to them will allow them, again, to make sure that it is for a legitimate business purpose, that the check that they are signing for. Credit cards. So again, I mentioned instead of using debit cards, we really encourage people to use credit cards. Now, when you do use credit cards, you should probably have a credit card policy in place. And again, if that's something your organization needs, we can certainly provide that to you. Just let us know. If you do use credit cards, though, just like your bank accounts, you want to make sure that you limit the number of credit cards and users. Obviously, we don't want everyone in the organization to have a credit card. Establish a credit card policy. Like I said, if you need assistance with that, please contact us and we can certainly help you with that. Make sure your cards have dollar limits. Also, when you're establishing this credit card policy, you want to make sure people are aware of what they can and cannot use the credit card for. So, maybe the organization as a nonprofit doesn't want people to purchase alcohol. So you need to make sure that that is included in there. Obviously, you want the purchases related to business, the business purchases, but beyond that, you could have some instances where a certain organization will not allow certain purchases to be made. So you just want to make sure that that is included in the policy. And then also you want to make sure that you talk about what happens when someone uses a credit card and they, for some reason, lose the receipt or that they don't get a receipt. For example, maybe they're parking somewhere and they use their credit card to pay for parking, but they don't get a receipt. So what happens then? Do they need to support or to provide, just a written statement saying I was, at this meeting on this date and it was for this dollar amount for parking and I did not receive a receipt, or for larger purchases and they lost the receipt, are they required to, pay that money back? What is your organization's policy? You just need to make sure that you put something in place for when that happens, because it will happen. Obviously, you want to require original receipts to be submitted. So you're going to get your credit card statement at the end of the month, and you want to make sure each one of those charges on that statement has an invoice or a receipt that goes along with it. You want to make sure that those people that use the credit card, for the purchase, that they submit those receipts timely, because you are going to need those each month when you reconcile the credit card statements. And then obviously the review process for the credit card statements. Usually if a executive director or a CEO has a credit card statement, we encourage a board member like the board treasurer to just kind of take a look at those credit card statements, either monthly or quarterly, just kind of to monitor what's going through there, making sure that that what it's being used for is legitimate business expenses. So again, when they do review that, initial and date, making sure that they document that review. Next, we have payroll. So making sure the issue with payroll is that people are getting paid more than what they should be. So maybe fudging hours, or there's ghost employees. So people that aren't actually on the payroll are being paid for payroll that services that they haven't done. So making sure that someone reviews and approves the timesheet. Obviously, you want this done by someone that is familiar with those employees. You don't want it done by someone that has no idea when this person works. So making sure that the department head or the manager reviews the timesheets for reasonable hours. You also want to review and approve your payroll register. So even if your organization uses an outside payroll provider and then that payroll provider processes the payroll and then sends you back a payroll register, you really need to look at that to make sure that things are being done properly, because we have seen instances where taxes are not being taken out properly and other instances where things just are not being done right. So you really want to make sure that you review that to make sure that the hours are correct and it looks like the proper withholdings are being taken out. Establish a process for any kinds of changes to payroll, whether it be new employees, or if employee quits, or if there's a termination, and also pay rate changes. So you want to have a process in place so that not just anyone can go in there and make these changes. You want to make sure that there's proper oversight on those changes to payroll. Utilize direct deposit over checks. I think a lot of organizations have gone to that. It's just much easier than issuing checks. And then finally, use a payroll provider. I know that there was an issue with a payroll provider a couple of years ago, but normally a payroll provider is more up to date on what's going on as far as the taxes and can process those, make sure things are being done properly. So we recommend that an organization use a payroll service. However, saying that, it is very important that you review the documents that they provide to you to make sure that what they're doing is reasonable. Next is financial reporting. So your month-end financial statements, your year-end financial statements. So these are what your board, your leadership, your management is looking at to make decisions, to make sure the organization is meeting its mission. So look at your chart of accounts. You should have a detailed chart of accounts, but is it too detailed? Is it giving you the correct information? Do you have the right accounts that you need to make decisions in your chart of accounts? Use your budget. Most times each month a board will look at financial statements compared to budget, which they should. So if you're not doing that, make sure that you're using your budget each month to see where you're at. So your budget was your plan that you created at the beginning of the year. So now we're comparing it to what's actually going on. Are we on the right path or are we not? So we really need to ask about those variances between budget and actual and determine why. Because if there are big variances, that may be a sign of fraud. Or it could be that maybe something just didn't get put in the right account. Maybe there was just an error. But then also, if you're not seeing a variance and you're expecting to see a variance, you also want to inquire with that as well. Timely comparative financial statements. The board should be reviewing financial statements timely. Otherwise, they aren't making decisions on the best information. So you really want to make sure that you can get those accurate financial statements to your board to review timely so that they can make decisions. You don't want to provide them with 3-month-old financial statements because that's, that happened 3 months ago. We're past that. We want to make sure that they're getting the information timely. And then also implementing a policies and procedures manual for financial reporting. If you, again, need a sample, we'd be happy to provide you with that. Month-end checklist, what needs to be done each month, and then also at the end of the year. And then finally, journal entries, reviewing journal entries. Journal entries are one way that the financial statements can be misstated. Someone going in and making journal entries to move activity around, putting things in a different account, hiding things. So really want to make sure that your journal entries are reviewed monthly. Again, I would recommend that maybe the board treasurer or, someone above the person making those journal entries looks at those reports. Again, initial sign off, because if you don't initial and sign off, it doesn't show that, it doesn't document it, that it happened. And if the individual maybe is not as accounting savvy or financial savvy as maybe you would hope that they would, if they are looking at journal entries month after month, they're going to see what journal entries are made. So it's, make sure just providing that oversight and encouraging them to ask questions if they have questions why these journal entries were made, or hey, we usually make this journal entry, why didn't we make it this month? So encouraging them to ask questions on that, just making sure that someone is looking at those journal entries, because again, that is a big area where your financial statements could be misstated. And then finally, we have technology, which really is implemented throughout the whole entire organization. And we could go into all kinds of paths down technology, but just kind of some basic overview, restricting access if to your accounting software, making sure that each individual that gets into the accounting software has their own unique passwords and IDs. Backing up your data off-site, making sure you're using antivirus software, spam filters, firewalls, all that good stuff. Implement policies on computer usage. So can your employees, can they go onto the internet and check their email and check Facebook during business hours? I don't know. That's something that you could consider, because there's a risk when they're out there on the internet that someone could access your site or access your information. So something to think about as to what you are going to allow your employees to access during work hours or with a work computer versus home. And again, that's kind of along the lines of training staff on just being aware, especially with the constant changes in technology, the phishing schemes, don't click on links that you don't know who they're from, don't open emails, that type of thing. So again, it's just a lot of education. And then also reviewing system access logs for suspicious activity. And that could be, your overall computer system, who's accessing it, your accounting software. So just kind of making sure that you're aware of what technology is being used, who has access to it, and that there are controls in place. So segregation of duties is a key control of activities. And again, we don't expect small organizations to go out and hire 8 more people to join their accounting department so that they can have the duties segregated. You need to segregate your duties as much as possible with the people that you do have. And really this means separating duties so that no one person has total control of a transaction from implementation to completion. An internal control system is only as effective as the employee who must comply with it, because we said before that, controls are affected by people, and people can do different things. And when you have different people involved, it's going to affect the controls. So employees really need to understand their roles and the importance of controls in place. So again, separating who is authorizing transactions, who's approving them, versus who's actually recording them in your accounting system, and then who's actually maintaining the custody of the assets, the checks, that type of thing. So we have a couple of examples here of how you can segregate duties with a 4-person, a 3-person, and 2-person staff. So for example, in this first slide here, we have an executive director, an accounting staff, an accountant, and then 2 other roles. And this doesn't need to, the slide says accountant or other. It doesn't necessarily need to be an accounting personnel. It could be a non-accounting personnel, such as a receptionist or administrative personnel, who can be trained to perform some of the less technical duties. Obviously, you're not going to want them to enter journal entries, but you could train them to do some of the more non-technical tasks that need to be done. So that way you can further segregate your duties. You could also use board members. So it could be a board treasurer or another board member as opposed to an administrative staff. But you can see here how we're segregating duties between the 4 people. Obviously, the executive director is kind of more at the top, signing the checks, signing the contracts, review. And then we have the accounting staff that's actually writing the checks, reconciling the bank statement, recording information. And then we have our 2 other people that are involved to kind of segregate the mailing of the checks, the reviewing of the bank reconciliation, approving payroll and such. So if you're an organization that's able to have 4 people involved, here is an example of how you could segregate duties between those 4 people. And then if you only have 3 people, here is an example of how you could segregate duties effectively between 3 individuals. Here we have an executive director, an accounting staff, and then an accountant or another person. And again, the accountant or other person could be a board member or an administrative person. But again, trying to segregate duties between the recording, the approval, and the custody as much as possible. And then finally, we have 2 people. So if your organization only has 2 people, and everybody should be able to do this, because even if you don't have an executive director, you should have at least 2 people on your board. So you should have 2 board members at least that you could segregate these duties between. So again, we will email out the slides afterwards, so you will be able to have a copy of these examples of segregating duties between 4 people, 3 people, and 2 people. All right, so we've gone through and we've looked at our tone at the top, we've talked about risk, we've implemented some controls, but in order for these controls to work, people need to know what they are and what part they play in the process. So it's great that you go through and do all these policies and procedures and controls, but if you're not telling anybody about it, they're not going to get followed. So we need to communicate. We need to communicate what responsibilities each people have. So whether it be your board, your employees, your volunteers, what are they supposed to do? What role do they play in these controls? Set responsibilities, again, communicate your policies and procedures. If you have written policies and procedures, you need to make those available to your people. Otherwise, they're not going to know what to do. You also need to make sure that you evaluate those every so often to see if they need to be updated. And again, just building an active communication into your culture, making it encouraging people to communicate, if they have questions, if they see something funny, just making it an open communication. So if they do see something, they do have questions, that they don't feel like they can't say anything. And then you also need to monitor. So this is not a one and done process. We can't say, okay, we looked at our controls this year, now we're done for the next 10 years. That's not how it works. External influences, such as changes in the social, economic, political, and regulatory environment. So for example, we went through the pandemic and a lot of people started working from home. So because of that shift from working in an office to working at home, organizations really should have gone through and evaluated their controls to see how those controls needed to be changed for remote workers. Shifting needs of communities served by the entity can also influence a nonprofit's risk. You take on new programs, maybe you move your location, you add more staff, there's a reduction in staff. All of these things can change will change your organization. So when those types of things happen, you need to go back and look at your controls and see where you need to change those. Because again, this is a continual process. It's not a one and done. You need to review it regularly and determine if it is working. Because if it's not working, then okay, we need to make some changes. Also, along with monitoring, here's a few things that you can do. Again, we talked about technology, reviewing system access logs to verify individuals accessing the information. One thing that we do a lot when we work with clients that have QuickBooks is we go in and look at the audit trail. So we can see who is making changes. We can see who's making journal entries, who's deleting items from QuickBooks, who's changing the payee, that kind of thing. So that's something that you can do as far as the accounting software is going into seeing what activity is being done then. If you want to, you could go through and periodically select a random transaction to inspect for proper authorizations and compliance with policies. So, large nonprofits have internal auditors that do this kind of stuff, but, you can say, hey, this is what we're going to do every so often is we're going to go through and make sure the processes are being followed. We're going to select an item and follow it through from the beginning to end to make sure that it's being done properly. Another thing to do is to keep up-to-date job descriptions. So obviously everyone within the organization needs to have a written job description so they know what they are supposed to do. Make sure that it is updated. So if there are changes, and then observe those individuals performing their duties. So are they doing what their job description says that they're supposed to be doing? Does it need changed, or do that what they're doing should be changed? Those need to align. And then obviously the independent reconciliation of account balances, which should be done every month, but just, making sure that the reconciliations tie out, make sure that your financial balances are being reported properly. So that's all we have today for controls. I don't know if there's any additional questions that we need to go over at this time, but again, thank you for attending, and we will have those slides, especially I know that some of you probably are interested in the segregation of duties between the 4, 3, and 2-person individual staff. So we'll make sure that we send those afterwards. And I think I'm going to turn it back over to Tyson.
Thank you, Carrie. Just a reminder, like Carrie said, this session will be recorded. The slides and the video will be available on the DWD website in the not-for-profit section. A link will also be emailed out to everyone that's attending today. While you're on that page, make sure you register for our next webinar. It's going to take place on March 10th, and it'll be covering board governance. I want to thank everyone for joining this morning. Have a great rest of your day.